Welcome to this analysis from the Gambling Databases research team. We're a group focused on delivering, really deep data-driven looks at the global iGaming landscape.
Exactly. Our whole mission is to help you cut through the noise.
Right, to understand the unique challenges, the opportunities in each market, and really deliver those critical insights you need for strategy.
And today, we are focusing on Zambia. This is a southern African market that presents, well, one of the most compelling paradoxes we've seen.
A paradox? How so?
You've got this intense domestic enthusiasm, especially for sports betting.
Okay.
And that's coupled with a proactive, pretty modern regulatory framework. So on the surface, it just screams opportunity.
But I'm sensing a but here.
A very big one. As we're going to unpack that surface attractiveness, it hides this really complex, high-extraction environment that we've started calling the honey trap.
The honey trap. Okay, I'm intrigued. Before we get into the mechanics of that trap, though, let's just lay out the high-level facts. What do people need to know about Zambia right now?
So the foundation is quite robust. Gambling is fully legal. It's regulated for both land-based and online activities.
And who's in charge?
The main regulatory body is the Betting Control and Licensing Board, or the BCLB.
And what are we talking in terms of market size?
We're estimating annual wagering at over $300 million.
That is substantial, especially given some of the infrastructure issues we'll get to later. So what does the future look like? I mean, for growth?
Our forecast points to a very healthy compound annual growth rate, the CAGR. We're looking at 15 to 20% over the next 5 years.
15 to 20%, that's huge.
It is. It suggests a lot of untapped potential.
Yeah.
But maybe the most surprising metric right off the bat is this.
Go on.
There are already 99, that's nine, officially licensed gambling companies operating in Zambia.
99? Wow. That is a seriously crowded field for a market of that scale.
It really is.
Okay, let's unpack the regulatory side of things, because it sounds like the government's been pretty active here.
Extremely active.
Compared to a lot of other African nations where, online legality can be a bit murky, Zambia seems to have provided a really clear path for operators.
And that clarity is the market's biggest selling point. Gambling is legal under various acts, but the crucial part is that online is explicitly recognized, it's regulated, and it requires a license.
So no gray area.
None. You don't have to worry about operating in some legal twilight zone, which, immediately de-risks the compliance side of things when you're looking to enter.
Now, you mentioned a 2025 overhaul. We see a lot of jurisdictions struggling to update old, almost colonial-era laws for modern apps and mobile money. What was the driver here? What did this bill achieve?
Well, historically, Zambia's gambling laws were just a fragmented patchwork. They were designed for things like lotteries and physical casinos.
Not for an iPhone app.
Exactly. They were totally silent on things like mobile betting or, live dealer interfaces. So when the cabinet approved this big comprehensive bill in mid-2025, the goal was unification.
To bring it all under one roof?
Precisely. It signals a shift from sort of passive regulation to really active management of the sector. It specifically addressed mobile tech, standardized licensing, and really importantly, closed some major consumer protection gaps.
Okay, so if I'm an international operator listening to this, the application process sounds, it sounds almost too good to be true. Simple and cheap.
It does.
Give us the hard numbers. What's the real barrier to entry?
The timeline is manageable. You're looking at 3 to 6 months to get a license. Foreign ownership is openly permitted. Very few restrictions there.
And the cost. This is the big one.
This is the initial bait in our honey trap. An online casino license, for instance, costs between 500,000 and 1 million kwacha.
And in U.S. dollars, that is.
That's roughly 18,000 to 36,000 U.S. dollars.
36,000 maximum for a full online casino license in a $300 million market. That's incredibly low.
It's almost unheard of in established jurisdictions. It suggests the government is trying to maximize participation.
Exactly. Low entry costs, clear laws, massive growth forecast. So that brings us back to that paradox you mentioned. If it's so good, why isn't every international giant already there?
And this is where the financial reality just hits you like a brick wall.
This is the trap.
This is the trap. The low entry fee gets you in the door, but the tax regime ensures you pay exponentially more on the back end. This is, without a doubt, the single biggest operational risk warning for Zambia.
All right, let's pull the curtain back on this predatory tax structure, as you've called it. Break down the stack of taxes an operator has to face.
Okay, so it's a compounding nightmare. The first, and honestly the most debilitating layer, is a hefty 40% gross gaming revenue tax.
40% on GGR.
Yes, specifically on digital gambling. To put that into perspective, in a major hub like Malta, you might be looking at 15, maybe 20%. 40% immediately chops your potential net profit in half before any other expenses.
But as I understand it, it doesn't stop there. They also tax the top line, the turnover, which is highly unusual. Tell us about the excise duty.
That's correct. Layer 2 is a 10% excise duty on gross betting revenue.
So on the stakes themselves.
On the stakes, regardless of whether the operator wins or loses that money. This is just financially destructive because it kills your cash flow. You're being taxed on money that you have to pay back out to players as winnings.
So just to be crystal clear, an operator pays 10% on all the money they accept.
Right.
Then they pay 40% on the money they actually keep.
Right.
And then on top of all that, they still have to pay standard corporate tax.
Precisely. And that's the third layer. 35% corporate tax on whatever profits are left. When we model all of this, the total effective tax rate on revenue easily exceeds 60%.
60? Wow.
This structure is very clearly designed for maximum short-term government extraction, not for a sustainable partnership with operators.
That just destroys any conventional profit margin. But the government hasn't stopped with the operators. They're also taxing the players, which I imagine creates a huge churn factor. What's the tax on winnings?
Players get hit with a mandatory 20% withholding tax on their winnings. The operator is required to deduct this at the source.
I think we really need to pause on the psychological impact of that. A 20% tax on winnings. If I'm a player and I have a decent win, I instantly lose a fifth of it just for playing legally.
It creates a tremendous loyalty vacuum. You are essentially giving every single unregulated offshore operator an immediate built-in 20% competitive advantage.
Why would a savvy player ever choose a licensed site?
They wouldn't. Especially not a high-value player. They'll just go to an illegal site that's operating outside the BCLB's reach, avoid the tax, and get their full payout.
And that's the core driver pushing high-value players out of the regulated market. So you combine that with what I hear is pretty low consumer value. Profitability seems almost impossible. What's the ARPU?
The ARPU, the average revenue per user, is shockingly low for this level of tax. We estimate it's only about $45 to $55 annually per year. So you need massive, massive volume to even try and offset that 40% GGR tax, but each customer is only giving you $50 a year in revenue.
So what's the timeline to actually make your money back?
Our models show a time to break even for a new entrant is stretched to a very, very long 24 to 36 months.
2 to 3 years.
Right. And that's just not sustainable for most small or even mid-sized international firms.
Okay, that's a brutal financial reality. Let's shift focus to the consumer profile because despite all those hurdles, the demographics driving demand are undeniably strong. Who is the typical Zambian user?
We're looking at an incredibly youthful population. The median age is just 22.2 years old.
That's one of the youngest consumer bases in the world.
It is. It's ideal for digital services. And that key consumer base is heavily concentrated in urban centers, about 45, almost 46% of the population. Lusaka, the capital, has nearly 3 million people alone.
And that's where the growth forecast comes from.
It's that concentration of young, digitally aware people.
So we have a young, urban, hungry market. But we have to address the operational elephant in the room, infrastructure. How big a risk is instability for an operator?
It's a huge risk, a constant risk. While mobile penetration is high, over 70%, and most users are on Android, overall, internet penetration is still quite low, around 33%.
So it's a mobile-first, low-bandwidth market.
Strictly. But the critical operational challenge is that instability, specifically the high frequency of power outages. They call it load shedding.
Paint a picture for us. What does load shedding actually mean for an operator on the ground? It's more than just the lights going out, right?
Oh, it's disastrous for real-time betting. Imagine you're placing a live bet on a football match, or you're deep in a slot session.
And the power cuts out.
Or the 4G coverage just drops because the local cell tower is running on a generator.
Yeah.
That session is interrupted, the bet might fail, and these high failure rates, they just destroy the user experience, they erode trust, and they create huge customer service headaches.
And I imagine it's worse outside the capital?
Much worse. Outside Lusaka, variable coverage and reliability become major, major friction points.
Given that instability and the low rate of traditional banking, how are players even moving money around? It can't be credit cards.
Almost never. Traditional banking penetration is under 35%. The entire digital economy, really, it runs on mobile money services.
So MTN, Airtel.
Those are the giants. Providers like MTN Mobile Money and Airtel Money are non-negotiable partners. If you don't have seamless integration with them, you just won't capture the audience. They enable fast, low-friction deposits without a bank account.
And what are these users spending their $45 to $55 ARPU on? What are the big preferences?
Sports betting completely dominates. It's
Mhm.
about 65% of the market share, and that's overwhelmingly driven by football, both local and international.
And the other third?
Online casino games, slots, live dealer options, they make up the next biggest chunk at about 30%. But the focus for any successful operator has to be a low-bandwidth, optimized sports product. Speed and reliability over flashy graphics.
And on the consumer side, finally, how proactive is the BCLB when it comes to protection and compliance? Are they serious about it?
They're very clear on this, yes. They mandate strict age verification. Minimum age is 18. They require standard AML and KYC.
What about responsible gambling?
That's crucial for them. They require robust measures, mandatory self-exclusion programs, monitoring for suspicious behavior, clear limits. The legal framework is actually quite modern and demanding.
Which just adds to the cost.
Right. It emphasizes that conflict between the high cost of compliance and the very low potential returns.
So if we bring all these pieces together, the modern law, the low entry barrier, the high growth, and that punitive tax structure, what's the final verdict?
The final assessment holds true. Zambia is a classic honey trap market. The player access score is high. We rated it 8.5 out of 10. It's easy for the public to play legally. Right. But that crushing tax burden, combined with the low annual ARPU, it just makes sustainable profitability exceptionally difficult for most operators.
Okay, so who can actually make it work? Who are the select few that can navigate these razor-thin margins and turn a profit?
Success here requires two things: massive scale and hyperlocalization. First, this market is almost exclusively viable for large Pan-African operators.
Companies that are already in multiple countries.
Exactly. Firms that can leverage huge volume across their entire portfolio to absorb the high fixed costs and use their footprint as a kind of hedge against Zambia's high extraction rate.
And you mentioned a light product requirement. What does that look like in practice?
A light product is essentially a bare-bones version of your platform. Stripped-down user interfaces, minimal graphics, systems that are optimized for spotty, low-bandwidth connections.
So it works during load shedding.
That's the goal. It might even mean relying on efficient text-based interfaces, like USSD, for older feature phones. You're prioritizing function and speed over aesthetics. And lastly, you have to be willing to accept net margins below 10%.
You're playing for market presence, not immediate profit.
You're playing the long game.
So on the flip side, who should just cross Zambia off their list immediately?
Anyone focused on specialized high-margin content. Boutique casino operators, for example. The ARPU is just too low to support niche products.
And VIP-focused brands.
They will fail instantly. That 20% tax on player winnings is the absolute death knell for the VIP segment. Your best customers will immediately migrate to unlicensed offshore sites to protect their capital. If you need profits in the first 2 years, this market will bankrupt you.
That is a powerful analysis. It perfectly illustrates the difference between what looks like a legal opportunity and what's actually a financially viable one. And it leaves us with this final provocative thought for you to consider.
Go ahead.
Given the Zambian government's clear commitment to modernizing its legal framework, which gives it credibility in its decision to enforce this extremely high tax take, how long can the BCLB effectively compete with and regulate against offshore operators who offer players a 20% better deal just by avoiding the player tax?
That's the fundamental conflict.
That tension between the government's revenue goals and just basic consumer choice, that's what's going to define how this market evolves over the next 5 years.
It's a high-stakes battle between compliance and consumer incentive. No doubt about it.
For the full text of this and other country reports, including our analyses on operational requirements for market entry, you can visit our website at gamblingdatabases.com.